Welcome back to Talk Tickers. It is Wednesday, February 4th, 2026. I hope you've had your morning coffee, or maybe more appropriately for today's deep dive, your morning tea.
Yes. Very appropriate.
We are unpacking an earnings call that just wrapped up, and it is honestly one of the most interesting strategic pivots we've seen in the market this year. We're talking about IAC, Interactive Corp.
The anti-conglomerate, the company that, famously builds these huge businesses like Tinder and Expedia, spins them off, and then just starts all over again.
Exactly. But today, we aren't talking about dating apps. We're talking about a company that is reporting earnings while simultaneously trying to sell you, literally, physical tea.
And luxury walking tours, it sounds like a total grab bag, but as we listened to the Q4 2025 call, a really clear theme emerged.
It did. It's a story about the physical world kind of fighting back against the digital one.
It really is. And for anyone listening, if you're pulling up your terminal right now, the market is definitely waking up to this. The stock, IAC, is up about 4.5% in the pre-market.
Trading around what? $38 and change?
$38.45, yeah. And the volume is unusually heavy.
Right.
We're seeing about 3.5 million shares moving. The average is just over 1 million. So the street is paying attention, but, and this is the key, it's what I would call a two-handed story.
Okay, let's unpack that. What do you mean two-handed?
Well, on one hand, you have the top line, the revenue, which looks great, a solid beat.
Okay.
But on the other hand, the bottom line, the actual profit, is messy. And the guidance, well, management basically just threw the guidance playbook out the window.
We are definitely going to get into that guidance shock later. But let's start with the top line. What are the headline numbers?
So revenue. The consensus, what Wall Street was expecting, was $641 million. IAC came in at $645.98 million.
So a beat. Not a huge blowout, but a solid beat.
Correct. But the real story is inside their People Inc. division.
Yeah.
This is Dotdash Meredith, so think People Magazine, Better Homes and Gardens, Investopedia.
All those legacy brands.
Right. And their digital revenue is up 14% year over year.
14%. That might not sound like a huge number for a tech company, but for a digital publisher in 2026, that's massive.
It's huge. We've seen so many of these companies just fighting for survival. So how is Better Homes and Gardens growing digital by double digits? That's the core of their strategy.
But before we get there, you mentioned the messy bottom line.
Right. While revenue is up, if you look at their GAAP EPS, that's the official accounting number, they posted a loss of 99 cents a share.
Ouch. And the street was expecting a profit, wasn't it?
They were expecting a profit of 68 cents. So that is a huge miss on the official scoreboard.
Okay.
However, management and frankly most investors are looking at adjusted EBITDA.
Right. The proxy for cash flow. Can you just quickly remind us why that matters?
Sure. Think of it like this. GAAP earnings is your income after all the non-cash stuff, like depreciation. It's what you tell the IRS. Adjusted EBITDA strips out that noise to show you if the core business is actually generating cash right now.
So on the official scoreboard, they lost money. But on the cash flow scoreboard,
they made $142 million. And that's up 15% year over year. So the business is actually growing its cash generation, even if the accounting looks bad for the quarter.
that explains the mixed feeling then. You have to decide which number you believe in more.
Exactly. And it all really comes from People Inc. That division is the star of the show, with digital revenue of $355 million.
So that's the engine. But what about the other parts? There's Care.com.
Care.com is the laggard. Revenue there was down 9%. And then you have this emerging and other bucket, Vivian, the Daily Beast. That part actually flipped profitability.
Okay, so small bets starting to pay off.
Mm-hmm.
But the thing that really caught my eye, and I think the streets, was the guidance. They just stopped giving it.
Right. No more quarterly guidance. It's a bold move. It's Barry Diller, the chairman, basically saying, look, we're not managing this business for 90-day sprints anymore.
Which is refreshing, honestly.
It is, but Wall Street hates uncertainty. They did give a full year 2026 outlook for adjusted EBITDA between 260 and 335 million.
And that range is lower than people were modeling, right?
Yes, and that's the friction. Even with the revenue beat today, that guidance implies they're going to be spending a lot of money this year. They're telling the market, we're investing, and it's going to cost money.
Which brings us to the most interesting part of this, the People Inc. turnaround. We've been hearing for years that AI is going to destroy publishers.
Right. the distribution regime change, as they call it. And we finally got a hard number on the damage. They said Google search referrals are down 50% over the last 2 years.
50.
Half their traffic from search is just gone.
So if half your customers stop walking in the door, how do you grow revenue by 14%? How does that math even work?
It works because they stopped waiting for people to walk through the door. They started taking the coffee to where the people are. It's their off-platform strategy.
So instead of praying for a good ranking on Google,
they're pushing content directly to TikTok, to Instagram, Apple News. They stopped fighting those platforms and started using them.
I loved the example they gave about InStyle magazine and that show, The Intern.
Yes, such a perfect case study. It started as this cheap experiment, literally shot on an iPhone, making fun of themselves, cost almost nothing.
Low production, high entertainment.
Exactly. And now, that one franchise is generating between $500,000 and $700,000 in sponsorships per season.
That is wild.
It proves the point. Brands still want to be associated with things people actually like. AI can summarize a recipe, but it can't create a funny, culturally relevant video series. Not yet, anyway.
And that leads right into Barry Diller's big idea. He calls it the inversion.
It sounds complex, but the logic is really compelling. Diller's view is that those blue links on a search page are losing their value because of AI.
Because the AI can just read your article and spit out a summary.
Right. So the value of your text drops to zero. You have to invert the business. You have to turn your brands into physical products and services that an AI can't replicate.
This is where the tea comes in. Southern Living magazine is launching a branded tea.
And it sounds quaint, you know, a magazine selling tea. But think about the brand loyalty. If you've trusted Southern Living for recipes for 30 years, you're going to trust their tea.
And you can't download a cup of tea.
You cannot virtually drink tea. Diller also mentioned travel and leisure. They're launching luxury tours. He had this great line about the creators of the White Lotus.
I saw that. He said they would have creamed over their photo archives. Classic Diller.
But the logic holds. AI can write me an itinerary for Italy, sure, but it can't actually take me to a private vineyard in Tuscany. That's the moat.
It's interesting because they're using digital to sell real-world stuff, but they're not abandoning tech completely. They mentioned My Recipes.
Yeah, the recipe locker. They've hit 3 million users, 24 million saved recipes, and the kicker, they did it with zero marketing spend.
That's first-party data. They own that audience.
They own it. They don't need Google as a middleman. And then there's Decipher, their contextual targeting tool.
Okay, explain that. Contextual versus cookies.
So cookies track you as a user across the web. Contextual targeting just looks at the content on the page right now. So if you're reading an article about grilling, it shows you an ad for barbecue sauce.
Which is huge because privacy laws are killing cookies.
Exactly. So the strategy is monetize the brand physically with tea and tours, and build tech that bypasses the old search monopoly.
And it seems to be working. I mean, enough to offset a 50% drop in search traffic that's incredible.
That's the takeaway. They've proved they can survive the Google apocalypse.
Yeah. Speaking of the physical world, we have to talk about Diller's other obsession, MGM.
He loves Las Vegas.
Incredibly bullish. They bought another 1 million shares in Q4 for $40 million.
Which brings their total stake to about $2.2 billion.
That's the thesis there.
It's the infrastructure. Diller argues you just can't duplicate Las Vegas. The capital, the regulations, it's impossible. And more importantly, AI cannot disrupt the physical experience of a casino or a resort.
Right. He said, unless we're all in a simulation, nothing gets between the customer and the experience.
It's the ultimate touch grass asset. You have to be there. He's also looking long-term at Osaka, Japan, a $12 billion resort opening around 2030.
2030. He's patient.
They stopped giving quarterly guidance for a reason. He's playing for the next decade.
Okay, let's pivot to the trouble spots. Care.com. Revenue down 9%. What's going on?
It's really a macro issue. A big part of their business is selling care benefits to corporations, backup childcare for employees, that kind of thing.
And companies are cutting back on perks.
Exactly. They're tightening their belts. Management thinks it will return to growth by mid-2026, but right now it's a drag on the portfolio.
And Vivian, the healthcare staffing app.
That's actually turned a corner. It returned to growth in Q4. It suggests that whole boom and bust cycle from the pandemic has finally normalized.
One other thing that stood out to me, a big number, was the legal bill. $15 million this year on the antitrust suit against Google.
It is a lot, but you have to view it as an investment. They're not treating it like an expense. They're treating it like an asset class.
An asset class, like a venture capital bet.
Precisely. They're looking at the precedents from other publishers. If they win, or if Google settles, the damages could be in the hundreds of millions.
So it's a lottery ticket with pretty good odds.
An asymmetric bet. It costs them $15 million, but the payout could be 20 times that.
Okay, so let's zoom out. We've covered the tea, the casinos, the lawsuits. What does this all mean for someone looking at the stock? Why the mixed sentiment?
The so what really comes down to your time horizon. The bull case is that they've proved they can grow without Google search. They dodged the laser from the Death Star. Their brand defense against AI is working.
And the bear case?
The bear case is that this transition is expensive. That 2026 guidance includes 80 to 90 million in corporate overhead, plus those litigation fees. It is not a cheap company to run.
But from a valuation angle, it's trading at a discount, isn't it?
A significant sum of the parts discount. If you just add up their MGM stake, their Angie stake, the cash flow from People Inc., the current stock price implies you're getting some of these assets for free.
And management seems to agree because they're buying back their own stock.
Aggressively. They've reduced the total share count by 10% over the last year.
10% of the company retired in 1 year. That's a huge signal from insiders.
It absolutely is. And I think this is a case study for the entire digital media sector. If IAC can survive this, they become the blueprint for everyone else.
It's fascinating. It's like they're building a bunker against the digital apocalypse, but the bunker is filled with luxury magazines and casino chips.
A very Barry Diller way to survive the apocalypse.
All right. We have reached that time. We've looked at the numbers. We've analyzed the strategy. Now it's time for our segment. This is not financial advice.
Standard disclaimer applies. We're just brainstorming here.
Exactly. So based on this call, what's the wild trade that captures this thesis?
Okay, I'm calling this one the touchgrass hedge.
The touchgrass hedge. I love it. Walk me through the logic.
Look at what Diller is betting on. Things AI physically cannot simulate. You can't virtually drink Southern Living tea. You can't virtually replicate the adrenaline of a craps table in Vegas.
So while everyone else is buying compute power,
you go long IAC as an anti-AI, pro-physical reality ETF. It's a hedge against the singularity. If AI takes over all digital work, humans are going to have a lot of free time. What will they do?
They're going to touch grass.
Exactly. They're going to travel, cook, gamble. IAC owns the brands for the high-end physical world.
The analog renaissance trade. I like it.
And here's the kicker. If that Google lawsuit pays out, it's basically a refund on the last decade of monopoly fees. So you get the physical world hedge, plus a massive potential check from the digital world.
A refund on the last decade. That's a great way to think about it.
It is.
So the trade is buy IAC, drink some tea, go to Vegas, and wait for the lawsuit check to clear.
Sounds like a pretty good plan.
It's certainly more fun than watching a blinking cursor. All right, let's wrap this up. Recap. IAC delivered solid Q4 execution. They beat on revenue. Digital is growing despite Google. The guidance is murky because they're investing, but the pivot away from search is working.
And the final thought I'd leave you with is this. Barry Diller isn't waiting around. He is moving now to monetize these brands before ChatGPT eats them. He's moving faster than the rest of the industry, and betting against Barry Diller is usually a bad idea.
He is definitely not sitting still. That's going to do it for this deep dive. Check the show notes for a breakdown of that sum of the parts valuation. Remember, none of this is financial advice. We'll see you next time on Talk Tickers.
Thanks for listening.